In this video, I want to consider the characteristics, the features of high yield bonds, the features of junk bonds. We want to see how we can unlock the potentials of junk bonds, how we can tap into the high returns it provides. So high yield bonds, also known as junk bonds, are debt instruments issued by companies or governments with lower credit ratings. So here are key features of high yield bonds. So number one is the issuer. In this case, they are issued by companies or governments with lower than acceptable credit ratings. Ratings like triple B for Standard and Poor's, as well as Baa3 by Moody's. So all these bonds are rated lower qualities. They are rated, as lower quality bonds. And so they don't really the issuing company means it's not really doing well. It's not doing well financially. And so they have to issue these bonds to be able to attract investors who are looking for higher yield. Number two is higher yield. It offers higher yield, that is interest or coupon payments compared to government grade bonds, which are safe but of a lower yield. And it's for those investors who have appetite for increased risk and are also looking for higher return, who can stomach the risk and they have a desire for higher returns. Number three is credit risk. Higher risk bond, higher risk of issuers default due to the lower credit worthiness, the lower qualities of the financials of this company. So investors, face a greater chance of losing some, if not all, of their investments because of the nature of the company issuing it. Maybe company like this getting close to being distressed. So they issue these bonds and people still buy. Who can stomach the risk? Who can allocate a tiny percentage of their entire portfolio to it? So even if they lose the money, it doesn't really affect them that much. Number four is coupon payments. So they pay periodic interest or coupon, often semi-annually at a higher rate than investment grade bonds, reflecting the higher risk associated with this kind of bond, with these kind of investments. Number five is maturity. Maturity can vary from a short term, very few years, to as long as 10 years or more, depending on the issuer's need and market condition. If the issuers will want to keep this money for a very long time, then they can issue longer duration junk bond. If they want the money for a short period of time, for a short period, they can lessen the maturity, the duration. Number six is price volatility. They are more volatile than investment grade bonds, actually, especially when the economy is it's on a downturn. These that adverse changes in the economy, or if the issuing company is experiencing a worsening financial situation. If the financial condition of the company is not really getting better, but is getting worse, then it will invariably affect the par value, the quality, and even the return potentials of the bond. Number Number 7 here is liquidity. They are less liquid than investment grade bonds. That is, you cannot very easily sell them, you know, in the market, in the open markets, especially for smaller issuers, for companies that are not really, they're not big cap companies. So it's difficult to sell. If you want to exit your position, you find it very difficult to liquidate your investments. Number 8 is credit ratings. They are rated by credit agencies like Moody's, like Standard and Poor and Fitch. So bonds rated below triple B, are classified as high yield bond. Any bond that is rated by S&P as below triple B minus, then that particular bond is classified as junk bonds. Number 9 is risk of default. It's a higher risk the issuer will default on the bond because of their poor credit quality. Maybe if it's issued by a government, the government may not be, but maybe the government is experiencing instability. Maybe a country like, let's say, Haiti, and other war-torn countries like that, which may result in partial or total loss, for the bondholder. Number 10 is higher potential returns. It offers, higher potential returns, but at an increased risk. Don't forget that. Include the risk of default or downgrades to even a lower rating. Maybe when you bought, it was at a particular rating, but the bond, the issuing company or the bond may get downgraded further. That's where the risks come in. It could be downgraded. Number 10 is there's higher potential for return. That there's if the company does not undergo or the bond quality is not downgraded, then they stand to provide higher return potentials if the company recovers. Number 11 is callable bonds. High yield bonds are often callable, meaning that the issuer can redeem the bond whenever they deem fit. If the interest rate decreases, they can decide to redeem their bonds. It's an advantage to them actually. Number 12 is covenants. They may have fewer covenants to protect investors than investment grade bonds. They have covenants incorporated into this investment. Although some high yield bonds include restrictions on the issuer's activities to safeguard bondholders. A typical restriction here could be that they are not permitted to incur additional debts, so that they will not be too overburdened by debts and may not be able to pay the bondholders. So they have to honor these covenants. Number 13 is economic sensitivity. It tends to be most sensitive to economic cycles, with price typically dropping when the economy is down. And then there's also, at that level, at that point in time, the likelihood of default will increase when the economy undergoes a downward trend. Number 14 is it is used in a portfolio. It's a kind of means of diversification. So often used by investors seeking higher returns for exchange for a more acceptable risk. So high yield bonds may be included in a diversified portfolio to boost income potential. You have a diversified portfolio and you can afford to allocate a tiny part of your capital to high yield bonds. It's okay. If it makes money, fine. If it doesn't make money, you don't really stand to lose too much. And so high yield bonds are suitable for investors who are willing to accept the risks of potential defaults in exchange for the possibility of a higher returns. They can be a good option for those looking to diversify their fixed income investments and increase overall yields.